Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class. In this week's episode, we're going to be talking about the common mistakes which Forex traders make, especially beginners and traders who are intermediate traders who are still struggling to become consistently profitable traders. So it might be that you've been trading Forex for years, and if you haven't had a professional trader who's been consistently profitable trading, to point out the things that you're doing that's preventing you to become consistently profitable, then this is a video that you definitely want to watch. You definitely would not want to miss out on this, on watching this video, because this might be the turning point in your trading career. Okay, there are things that you might be doing which you don't know are causing you or are preventing you from achieving your goal of becoming a consistently profitable trader. And that's exactly what we're going to be talking about in this video. And for those of you who are completely new to trading, and maybe you've just managed to learn a little bit about the terminologies of trading and you haven't, dabbled in the markets that much, then you're extremely lucky, because this video is actually going to point you in the right direction to know the things that you're not supposed to do as you get your footing in the forex markets. Okay, so without wasting any more of your precious time, let's dive right into it. Okay, so first things first, the first thing which we're going to be talking about, which is a common mistake that most traders make, and the reason why I'm bringing this first is because it's one of the most overlooked trading mistakes that a lot of newbies find themselves making. Okay, so this is the first mistake that we're going to be talking about, and that mistake is none other than practicing proper risk management. So let me give you a little backstory, okay? You see, when I first started trading, okay, I always had the assumption that there's someone out there, somewhere out there on the internet, who has a trading system or a trading strategy or a trading bot, something that would just tell him when to buy and when to sell. And, for whatever reason, I thought at that moment in time that that person or that entity or that whoever that might be knows with 100% accuracy what the outcome of the trade he was going to take is going to be. So because as humans, we have that natural disposition to want to stay away from taking losses. That manifested itself in me trying to find a trading system which is known in the trading community as the Holy Grail trading system, which would give you 100% winning trades all of the time. And at that particular moment in time, I thought I was the only one who kind of had that urge, okay, to find a trading system that would give me 100% winning trades 100% of the time without taking any single loss, okay? And that was also fed by the gurus and the unethical traders who are trying to peddle their, trading bots and trading services or signal services or anything. It was also strengthened by those traders because they made it seem that if you just bought what they were selling, then you would win 100% of the trades you take. You don't even need to, you're not going to lose anything. And so since you're not going to be losing any trades, or maybe if you're even going to be losing trades, it was going to be less than 10% of the trades you took, then what use would risk management be? I hope you're getting where I'm going with this point. Because the idea is, if for whatever reason, you had a trading strategy or a trading methodology which would give you winning trades almost 100% of the time, way past 90%, maybe 95 or whatever amount of percent of the trades you took were all going to be winning trades, then what would be your incentive to practice proper risk management? Because the idea is the only reason why you'd want to practice proper risk management is because you've accepted that there's a possibility that the trade you take or the trade you're going to be taking in the market, there's a possibility that it's not going to turn out the way you expected it to turn out. But when you are getting fed lies and deceit by those, unethical traders and unethical vendors or signal service sellers or whatever the case might be, that the trading method they are using or the trading strategies they are using or the bots they are using would win trades for you 100% of the time, of course you're going to be downplaying the importance of risk management. And this is one of the things that caused me to spend years and years and years running around in circles trying to become a consistently profitable trader without knowing that my whole idea of profitable trading was flawed from the get-go, from the foundation. Because the idea is, if I had at that particular moment in time understood that I would have to accept that I cannot win 100% of the trades I take. If I, from the get-go, if a professional trader who was doing this for a living sat me down and made me understand that I am not going to win 100% of the trades I took, and so because of that, I need to make a plan so that something that I do in my trading, and we're going to talk about that, but something that I do in my trading is going to compensate for those losing trades that I'm going to take in order for me to become consistently profitable. Then it would have been much easier for me to become a consistently profitable trader, because from the get-go, I would have accepted this and I would have tried to work around it. But because of the ads and the sweet the snake oil salesmen out there and all of those things, people trying to sell me those bots and all of those things, I was of the assumption that if I wasn't winning all the trades I took, then it's just because the person teaching me didn't know how to trade well, or maybe he just didn't know how to trade at all. So I would go on to look for the next person who is going to give me that. And I kept going from one person to the next, from one bot to the next, running in circles, like I keep telling you, and only for me to go on for years without becoming consistently profitable. So this is not just to point out the mistakes for you. Is to point out the mistakes for you and then to give you the solution of how to combat that mistake for you to become a consistently profitable trader. And that's what we're going to be talking about right now. So if we accept that one of the biggest mistakes that is preventing profitable traders from becoming profitable is practicing proper risk management, then let's talk about risk management now. I want you to understand one thing. There are thousands, or let's even say more than you can count, okay? Variations of trading strategies that you can use out there on the internet. There are traders who use trading strategies that depend on the use of indicators, technical indicators. So for example, one trader might tell you that, okay, I use moving average crossovers. So when one moving average crosses above the other or crosses below it, I'm going to either buy or I'm going to sell, whatever the combination might be. A strategy, in a nutshell, is just an approach that a trader uses to identify when to buy and when to sell, so that the probability of price doing what he expects price to do is a little much higher than it doing the opposite of what he expects it to do. So some traders use, like I told you, some traders use indicators to identify when to buy and when to sell. Some traders use raw price action. Whatever method you use, I want you to have one thing at the back of your mind. That one thing is that no matter what you do, you are not going to win 100% of the trades you take. The only way that you can win 100% of the trades you take is if you have somehow, something or crystal ball that is going to tell you what is going to happen in the future. And since you and I are human, then I'm pretty sure you don't have that. And so you're not going to know with 100% certainty what is going to happen in the future. And because of that, since you don't know with 100% certainty what's going to happen in the future, then this makes it 100% important for you to protect yourself in the eventualities when price does what you were not, what doesn't favor you. So let me give you an example. You see, this is the currency pair. This is the 4-hour chart of the gold currency pair, okay? So if we were trading without indicators, for example, this is just an example. This does not mean that the strategy I'm showing you now is more superior than the other strategies out there. In fact, the trading strategy I use, and I've been showing you guys that trading strategy for a long time in this classes, is a trading strategy that uses, indicators, moving average indicators and fractals. Is a simple trend following trading strategy, okay? But just to make things simple, just to keep things simple, let's use this example of a price action trading strategy. So the idea here is that when you're using price action to trade, and let's say you're using market structure, you would want to buy and sell when the market is trending in a direction, okay? So if we look at this chart from this particular place on the chart, you'd notice that price was actually making lower lows and lower highs, lower lows and lower highs. But then all of a sudden, when it made this low, it couldn't make a low which was lower than this particular low. And so this would be our origin low, okay? And so it made a low after forming this low, but that low could not break below this low. And so this is a higher low, okay? Now in trading, when we're using market structure, when price forms higher highs and higher lows, this is telling us that we are in an uptrending market. So the idea here is that if price is in an uptrending market, the probability that price is going to continue breaking above resistance level, levels, okay, and forming brand new highs is much higher than the probability that price is going to break below, okay. So let's assume that price formed this low, and then it formed this high, and then it made this pullback which couldn't break below this low, and then it formed this high, and so this was the making of a uptrending market, okay. So in theory, what we want price to do, or what we expect price to do, is for it to continue moving in the direction of the trend. So let's assume that when we had this pullback here, since we already have the structure of a market, of an uptrending market, you could have been of the assumption that, okay, price is in an uptrend. And so when you had something like this form, this bullish engulfing candlestick at the end of this particular up move, you would have wanted to place a trade here with your stop loss being somewhere just below this low. If you're trading with a tight stop loss, we've talked about this in our risk management classes in the past, there's two approaches that you can take for this, okay? So the first approach is for you to use this previous low, okay, that we have here, okay? And you can see that this is very far from where price is. The advantage of trading like this is that price is going to find it very difficult to hit your stop losses. But the other side, the disadvantage is that since price is very far from your stop loss, then if you are trading with a fixed risk to reward ratio like 1:2 or whatever, then you can see that this particular trade, before it would hit your profit target, it needs to come all the way up here, which is quite a distance even for gold here. This is the 4-hour chart. So this trade could end up taking weeks or whatever the case might be. On the flip side, there are aggressive traders who would place their stop losses very, very tight, just maybe right below the area that it was here, okay? Somewhere here when this pullback happened, okay, just somewhere here, and then they would place their profit target if they're trading with a fixed profit target like 1:2. But most times this type of traders, the traders who use this type of very, very tight stop losses, they tend to trade with a higher reward to risk ratio. What I mean is, instead of going for a 1:2, because their stop losses are very close, they are going to get stopped out much more often. And so what these traders tend to do is they tend to aim for a profit target which is like 3 times or 4 times or even 5 or 10 times what they are risking on a trade. The reason why they do this is because since their win rate is very low, if they just get just one winning trade or 2 winning trades or whatever the case might be, then that would compensate for a lot of losing trades. And so that low win rate that they have will not bother them all that much. Because just one winning trade, if they are aiming for a 1:5 risk to reward ratio, for example, would make up for 5 losses. Okay? So let's assume that you are trading like this, and you understand and you understood and accepted the fact that price is going to have whatever the strategy that you're using. There are times when price is not going to agree with what you're doing. So let's say you place this trade and you are going for the conservative stop loss approach. Okay? Let me quickly do this because I'm finding it a little bit difficult to do this. So let's say you are going for 1:3, okay? If you are going for 1:3, or let's go for 1:5, like we're using in this particular example, you can see that price moved in your favor, but then all of a sudden it hit your stop loss here. So this would have been a losing trade. But then let's assume that you kept doing the same thing, and so price continued moving, forming a market structure of uptrending market, okay? So it kept forming higher highs, and now instead of higher lows, we are having price finding it difficult to continue doing that until it broke above this. And then when it formed this and made this pullback, this would have been our cue after the formation of this bullish engulfing candlestick to place a trade here with a stop loss maybe right below here. If you went for a target of 1:5, you can see that price would have hit your profit target somewhere here. This particular winning trade would have made up for the loss that you took here. So in essence, what does this have to do with anything? This is telling you that if, for example, you took this losing trade here and you're risking 1%, and then you took this trade that you took, you're risking the same 1%, and you made a profit of 5% here, this 5% would have covered for 5 losses, okay? So in this case, let's assume you had let's assume you took 100 trades and your win rate is only 30%, for example. So out of those 100 trades, you would have lost 70 trades, okay? And you would have won 30 trades. But since you're trading with a 1:5 risk to reward ratio, this would simply mean that for the trades that you lost, okay, you were risking 1%, okay? So 1% would now mean that your gross loss is minus 70%, okay? Minus 70%. because each losing trade, you incurred a loss of minus 1%. But what about the winning trades that you took? For the winning trades you took, each winning trade gave you a profit of 5%. Okay? 5%. Sorry, 5%. And so here, when you multiply 5% for each winning trade times the 30 trades that you took, you would be up with a profit of around 150%. So now, when you do the math, you'd realize that when you subtract your gross loss from your gross profit, you would end up with a net profit of 80% plus 80%. Okay? So now, you might be talking with somebody, a trader friend of yours or whatever, and then he might be boasting to you about his trading strategy and how his strategy has a 90% win rate or whatever the case might be. And then at the end of the day, he might ask you that, okay, what trading strategy do you use and what's your win rate? And you might just tell him that, you know what, I use a simple market structure trading strategy and it's price action based and I only have a 30% win rate. He might even laugh at you for not having a trading strategy that wins most of the time. But then when the numbers are delved into, he will just realize that you almost doubled your account with only a 30% win rate. You almost doubled your account. You're only 20% away from doubling your account. And I'm pretty sure that the person who has that 90-something% win rate, that is boasting of that 90-something% win rate, if you were to look at his numbers, his profit would be nowhere near what you would have made with your trading strategy, especially if it's trading with a negative risk to reward ratio. And this goes to show you that most traders are focusing on the wrong thing, because when we first get into trading, the idea for us is to find a trading strategy that would win, most of the trades that he took, or maybe even all of the trades that he took. But then you'd find out that most times the trading strategy that will be right a lot of times is not going to make as much profits than the trading strategy which will be right only a couple of times, but then the size of the profits from those winning trades are much larger than the size of the profits of the losses from the losing trades on average. So I need you to understand now that for you to become a consistently profitable trader, that does not mean that you're winning every single trade that you place or every trade call that you make, like, the Euro USD is going up or this is going down, that every single call you make is going to, do exactly what you expected it to do. No, that's not the truth. In trading, you need to understand that just because you have a trading strategy that is, right more than it's wrong, does not mean that you're going to make much more profit than somebody who has a trading strategy who only calls winning trades like 30% of the time, as long as their profits is much bigger than the losses that they take on average. Okay? And this is why risk management is one of the very common reasons why traders find it extremely difficult to make money through trading, because they assume that if they ignore risk management and just go on the search to find that trading strategy that is going to win, 90 or 100% of the trades they take, then they are made for life, because, they can just keep doubling their accounts and rinsing and repeating. While it's completely not true. You could have a trading strategy just like I showed you here that has a very, very low win rate, but if the profits you make on average are much, 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 much larger than the losses you take on average, then trust me, you're going to do very well in trading. You're going to make much profits. The problem is most traders, because I've been doing this for years, I've been coaching traders and trading also for myself for years. The thing is, most times when I explain this to traders, they do understand it. Okay, it's easy to understand that, aim for a high risk to reward ratio, keep your risk consistent, and all of those things. It's easy to understand, but it's not easy to implement. What I mean is, you might tell a trader that, okay, this is what you need to do, this is what you need to do. But then when he goes to trade the market and then he places his first trade and it turns out to be a losing trade, places the second one, turns out to be a losing trade, the third turns out to be a losing trade, that is the moment that you start doubting the trading strategy that you taught him. And so he's going to start, trying to tweak the trading strategy to change it a little bit. Okay, maybe, when I took this trade here, price moved in my favor for like 1:2, and then eventually it came to hit my stop loss without actually going to hit my profit target. So maybe on the next trade that I'm going to take, I'm going to go for a 1:2 risk to reward ratio. And then, when he starts doing this, guess what? He's playing with the numbers of his trading strategy. And so now, because he's just lowered his profit target, when price ends up hitting this profit target of 1:2, and then it goes to hit what would have been his original profit target, he would now start, instead of being happy with the profits he made here, he's now going to start getting angry because he's going to look at the profits that he missed out on. And so subconsciously, this would start getting to him. And so instead of risking 1% of the next trade that he will take, he will want to get back the profits that he would have made here. And so he might end up risking 2% to make back what he didn't make here. And start aiming for that 1:5. He's just going to, change the trading strategy completely. And the discipline is going to go out of the window. And that's why trading is hard, because you can explain these things to people and it's easy to understand that, okay, I need to trade with a fixed risk reward ratio or need to do proper risk management, all of those things. But then when it comes to actually doing it in real time, when they get a couple of losses in a row, all of that rules and all of that understanding goes out the window and they give in to their emotions and start trading recklessly. Trading without proper risk management, it's out the window. Trading without following their trading strategy because they had a couple of losses in a row. The discipline, everything. This is why trading is extremely difficult. It's easy to understand what you need to do, but it's hard to implement it, especially if you don't have discipline. Okay? And so this is the reason why you need to know that, not just understanding why risk management is important, but when you get bombarded by those losing trades, those losing streaks, you need to know that that's when your discipline is tested. And if you don't stick with discipline as you trade, you're going to find it extremely difficult because you're going to keep making those mistakes. You're going to keep doing the things that you're not supposed to do. And that is only going to cause depletion in your trading account continuously. Okay? So now let's talk about the second thing. The second thing, I've hinted at it as we were talking about this particular one, is you not being disciplined. So let's assume that, just like I told you here, that you have a trading strategy that you've backtested, okay? You're risking 1% consistently. When you aim for a profit target, you're aiming for 5 times what you're risking on a trade. And so even if you took, from the numbers, we can see the numbers here, okay? So even if you took 100 trades and you only won 30 trades and lost 70 trades, you only had a 30% win rate. If you consistently risked 1% when you took those trades and consistently aimed for a profit target of 5%, at the end of the day, even though you would have lost 70 out of those 100 trades that you would have taken, you would have still ended up with a profit of around 80% of your trading account's capital. Okay? Now, what does this have to do with anything? Like I told you, I hinted at this in the past. When traders do this, when they go to the live markets to trade and then they place the first trade and then price doesn't do what they expected it to do, it hits their stop loss. They take the second trade, the same thing happens. The third trade, the same thing happens. Now it's getting more and more and more difficult for them to stick to the rules of their trading strategy. And so they will become indisciplined and then they will start breaking the rules of their trading strategy. If their trading strategy says they should only buy when the market structure has been completely formed and they have a reversal candle and whatever, if, for example, the past 3 or 4 losing trades that they took were losing trades, then they will now start saying, you know what, okay, maybe I might skip this trade because, it might just be another losing trade. And maybe that might be the winning trade. Or maybe they might say, okay, if I was aiming for a 1:5 profit target in the past and price just consistently comes to 1:3 and then reverses against me to hit my stop loss. Now they're aiming for a 1:2. Now they are not letting the numbers play in their favor, just like they've worked out. These are the things this is the moment when discipline is important. You need to let if you've backtested your trading strategy, your edge, on historical data and you've proven to yourself that it actually works, then when you're trading it in the live markets, it doesn't matter that the last 10 trades you took were all losing trades. You need to stick to the trading strategy with discipline. Discipline without deviating from its rules. If it says you should buy and risk 1% or sell and risk 1% and aim for a profit target, which is 5 times what you're risking, you do that whether the last 10 trades were losing trades or the last 10 trades were winning trades, without faltering, without changing the rules of your trading strategy, without a change in your discipline. Okay? And this is one of the things that traders find extremely difficult. Number one is to practice proper risk management alone is another thing, because they are out there looking for the trading strategy that will win 100% of the time. But then number two, when they understand that risk management is important and they understand how the numbers work out to work in their favor, you could have a low win rate and a high risk, reward to risk ratio, and then you would end up making profits after taking a large number of trades. Or you could have a high win rate and a modest risk to reward to risk ratio, and still end up making profits. Then when they find the trading strategy they find it difficult to stick to the rules of that trading strategy when they are facing a losing streak, or when they are facing a winning streak where they just placed 5 or whatever trades and they were all winning trades. Now they are getting overconfident, and so instead of sticking to the rules of their trading strategy, they feel like, you know what, since my strategy is such a good trading strategy like that, I'm going to bet all of my trading account capital on this trade because I want to double my account. And so it's difficult for them, whether they're facing a losing streak or a winning streak, to stick the simple thing, stick to the rules of your trading strategy. That's very difficult for them to do. Okay? And so this pretty much brings us to the end of this week's edition of the ITU Forex class. I really hope you learned something here, because a lot of traders just, when you sit down with a newbie trader or a trader, an intermediate trader who is struggling to become profitable, the first thing he would want to ask you is, what's your trading strategy? You're profitable, yes. What's your trading strategy? But then the truth is that even if you were to tell him the exact trading strategy that you are using, if you don't explain these things to him and don't instill into him the discipline and the mindset and all of these things that professional traders have, you could be trading the same trading strategy with somebody, but he is going to be finding it difficult to make money with it, while you easily breeze through it and squeeze profits out of the markets, because maybe he doesn't have the discipline that you have to trade with the strategy. Maybe he keeps sabotaging his efforts by doing, not sticking to the plan or doing improper risk management, all of those things, okay? And so, like I told you, this pretty much brings us to the end of this week's edition of the IT Forex class. And before we wrap up the class, I would like to use this opportunity to let you guys know about the other products that we have in the company, which are the ITU bots, okay, which are designed to trade on your behalf, identify low risk, high probability trading opportunities, and place those trades for you while you're out there doing what it is you want to do with your time, okay? They will place the trade, manage the trades. If you follow our risk recommendations, they will do everything for you from the get-go, okay? So if you're interested in it and you would want to get your hands on it, please reach out to us on the comment section or any of our handles on the socials, and we'll be more than happy to assist you to set everything up, step by step, and start earning while you're learning, okay? So I look forward to seeing you guys in next week's edition of the ITU Forex class, and I do sincerely hope that you found a ton of value in this week's edition. Thank you, and I really appreciate you making times out of your busy schedules to come to this class. I look forward to seeing you guys in next week's edition. Have a wonderful rest of your week. Cheers, and God bless you.